In this week's update, options expiry, so wait and see. It was volatility on steroids. And US earnings season, very stock specific as usual. My name's Garry Davis. As always, this is general advice only. And please remember, in the stock market, you can lose money. Right, let's start with a market update. What do investors need to do at this point in time? Because it's pretty confusing. We've got an enormous amount of cross currents. We've got a lot of things that are changing very quickly. And this is really just pretty much a reproduction of one of the slides I showed last week, and because I think it's a really important message, and sometimes it just gets lost in all the media storm that's out there. There's nothing more important than getting yourself clear and organised about what you're doing. And my experience over 20 years of working with people is that very few people actually take the time to do it at all, and certainly not to do it properly. So the more organised you can be, the clearer you can be about what your portfolio composition should look like for you. Just the more you can pre-plan. If the market does this, then my response will be this. The more you can think about it in advance, the less you tend to get caught out by the sort of volatility that we're seeing at the moment. So prepare your targets according to the composition that you think is suitable for you. I think when markets are at extremes, as they are at the moment, now they could go even more extreme in that direction, but it's always worthwhile looking at things, standing back and looking at things from a contrarian point of view. What if it is now so extreme that we're going to get a reversal? I'm not saying that's the case, but you certainly should be thinking about it. The natural human tendency is just to play it as it comes, just wing it. And if that's how you approach it, then once the mood improves, the market has already moved a significant distance, while the community thinking and all the data is still very negative. So, if that's what you're waiting for, then, you're going to miss the first 5 buses, that's for sure. You need to identify lower risk entries. When I look at a chart, that's trending, I look at where the support has been. Does it come in at the 20-day, the 50-day, the 200-day? How is the trend? What is the market telling us? Let's not be too creative. Let's assume that trend is going to continue until the market tells us otherwise. And then once we get into that zone, stocks don't become an automatic buy. Raging bull market, you can get away with that sort of thing, but in this sort of market, you can't. So identifying those potential support zones is really just the first step. You then need to look at the price action once it gets to that support zone to see whether it is in fact a buy, because in bear markets, support levels tend to break and resistance levels tend to hold. It's the opposite to a bull market. So just because a price pulls back to a support level in a bear market, you don't want to have an automatic expectation that support is going to hold. Let's jump into the market. American stocks ended up rising 4.7 for the week. And I must say, by the time we got to Friday, it sure did not feel like it. I was quite amazed when I, did the calculation and came up with that number, because it felt anything but a nearly 5% rise. But of course, a lot of that happened on Friday. Look, it's still a market that is absolutely about stock selection. And it's just one example, but there's a graphic comparison between the results of Netflix and the results of Snap. And Netflix went up 14 or 15% on unexpectedly strong results, and Snap was down about 25% on unexpectedly bad results, even though the share price had been declining all year. So this is very stock specific, and that's been the way it has been for a number of years. The other point I would make too, it's becoming very obvious that online advertising models, which sort of underpin certainly stocks like Facebook, or Meta as it's called now, and certainly Google, and a number of other stocks, that advertising model is in serious trouble. And the snap results really show that. So next week we've got reports from Meta, from Amazon, I think, certainly from Google and from Microsoft, all companies that rely heavily on advertising. And it's going to be very interesting to see the results from those companies, because if there is a significant long-term shift in the attraction of online advertising, then that could mean a significant change around in the leadership models of the market. We'll see from the charts that the intra-market money flows between the different sectors is still pretty poor. Got a little bit better on Friday, but it's not very exciting yet. So, I still remain, orientated towards being extremely cautious, not doing very much, and just, wanting to sit back and see what the market does from here. The US dollar index was steady at 112. The 10-year yield went up again quite significantly, and that certainly that caused some disruption on a couple of occasions during the week. But the fact that the 10-year yield went from 4.0 to 4.23, and yet the equities market managed to go up 4.7, that's the one that just didn't feel right to me. And so which one is right? Is it the market? Is this the bottom and we're now turning up? Or is the bond market right and yields are still heading higher, which will make it very difficult for stocks to go higher? I don't know the answer to that, and no one else does either. But I can tell you that I tend to believe when there's a conflict between the bond market and the equities market, I tend to believe the bond market, because it's just a more professional market. Generally with smarter players with much deeper pockets. So that's sort of where I sit from a fundamental point of view. But at the end of the day, I'm always more influenced by what the market is actually telling me. What is the price action telling me, not what the fundamentals should dictate. The VIX, was spent a reasonable amount of time over 30, which is a high level. Finished just a tick under it, thanks to the recovery on Friday. But look, these are still extremely high levels in the VIX. The 10-2 spread narrowed a little bit from 0.48 down to 0.28. So that's a bit of a positive, but not one that I'd want to actually hang my hat on, to be honest. All right, let's look at the charts. You can see here just the extreme volatility. The Thursday before last, we got this massive gap down and then a huge reversal that, to all intents and purposes, looked like it could be the bottom. And maybe, I'm not saying it's not, but it was then followed by a terribly negative Friday. And so if you recall from last weekend, I said, well, the jury's still well and truly out on whether this was a bottom or not. On Thursday night, Friday morning, this certainly looked like a fabulous reversal candle, but no follow through. Now, that was then followed by, a 4.7% up week in the S&P, but there was still selling. We gapped up on Tuesday, finished down again on Wednesday and Thursday, tried to rally Thursday, finished right on the lows, and nearly 200 US individual stock charts that I looked at, almost every one of them was absolutely on its lows. So things look very negative on Thursday night. But then Friday, we get a gap down, and then it all turns around. Supposedly because of some Wall Street Journal suggestion that things were getting better. I mean, that's just a nonsense. So to me, this is a week that should be ignored, because it was options expiry week. Anything can happen, and you tend to get significant short-term reversals. So stocks that have been weak, which is most stocks, tend to turn around because it's to the advantage of market makers for that to happen. So I just look at last week as a contrived period of trading, and I'm not assigning very much value to it at this point in time. The Nasdaq looks very similar. Just managing to climb back above the 20-day, but look, we're still in downtrend. All the moving averages are still pointing down, and pointing down, quite decisively. So let's jump in and have a look at the intramarket spreads. This is mid-cap growth versus the S&P. Not much encouragement there, I'm afraid. It's just stabilised, really, nothing much else. Semiconductors, I'm always exceedingly interested in what semiconductors are doing against the S&P. In a bull market, they need to be outperforming, and clearly that hasn't happened since November of 2021, November, December. It's been a downhill run for semiconductors. Now, the sector has got all sorts of headwinds because of the Biden administration's orders about the supply of materials and technology to China. So that is certainly impacting the sector. A little bit of a turn up on Friday, but again, nothing to get excited about. We've got lower highs and lower lows, and that's pretty much it. We really need to get back up here to about 1.54 before I would have any sort of positive feelings about semiconductors. Consumer discretionary versus consumer staples. Again, bit of a turn up on Friday, but again, that's just nothing. I would call that really just more stability than anything. This is the Nasdaq versus the S&P, slight turn up, but again, nothing to get excited about. 1,000 growth versus 1,000 value, same. Large cap growth versus large cap value, same story, and the same with small cap. So, I think there's just really nothing much we can take from last week is the bottom line. I think we just sort of, ignore that it happened and, see what the next few weeks brings, I think is the way to approach this. Now, I'll just finish on the US with just the overall sector charts. As I said, very stock specific. This is energy. There's no question that energy's been the strongest sector and still is. This is finance, even though the banks reported ahead of expectations and the share price response was reasonably positive. The bigger picture for finance is still down. This is technology. Absolutely key next week with with 4 of the major tech stocks reporting. I have no idea which way the tech sector could go next week. I think that Meta or Facebook is perhaps one of the really strong shorts out there. I think that their business model is broken. That's been my belief all year. So I can't imagine Meta reporting well and beating expectations. Microsoft and Google, they'll be the ones that I'll really be looking at. And this is consumer discretionary. Tick up on Friday, increased volume, but that's just one session, and I see the last couple of weeks as really just being a period of consolidation. Okay, Australian stocks, our dollar managed to recover just a little bit on Friday, finished at 63, and we've still got support at around 60. Our index was down 1.2 across the week. And it actually, our market felt better than that, and the US market felt a heck of a lot worse than a 4.7% gain. So, it's interesting the way your mind confuses the facts. And I think this is really just a timing difference with the US. I would expect we'll probably see a fairly strong index session in Australia on Monday. Lithium leading the way in Australia, still unquestionably the sector favourite in the Australian market. And there are hundreds and hundreds of lithium stocks. that are coming onto investors' radar, and it's almost getting a bit too frothy. You know, when you start to see stocks that have been, digging for gold or digging for copper or nickel, and they've been, doing that for 5 years in a certain area, and now all of a sudden they're starting to report, and the share prices have done very little of late. The market's been fairly disinterested in those sort of stocks. And now in the same ground, they've said, we've got some lithium targets, and all of a sudden the prices start to take off. It just all feels that it's getting a bit too jumpy and a bit too excitable for me. So, don't get me wrong, I think the outlook for lithium is extraordinarily good. And certainly the producers that are capitalising on these extremely strong prices are going to continue to do well. And some of the lithium developers are going to do extremely well, but they need to have something special. They need to have an X factor. And with hundreds of lithium hopefuls out there, you just need to be very, very careful about project selection. There's just something that I did forget to show. So let's just go look at the currencies. So this is the US dollar. So still clearly an uptrend, but a week or two of consolidation. And the Aussie dollar, strong on Friday, but before that it was looking pretty somber, and I still wouldn't rule out getting down to a support level around 60, which kicks in there. Okay. Now, precious metals, gold managed to rise mainly on Friday by $15 to $16.59. Translated to Aussie dollars, slightly lower because of the currency move down to 26.33, but that's still extremely profitable. I suspect from a contrarian point of view that the gold market is one that's going to come back into favour, but I just can't tell you when that is. I mean, it's been out of favour all year, and it will. I mean, common sense tells you that gold stocks will have their day in the sun again, but who knows? Could be 6 months, a year, 2 years. No way of telling at this stage. So it's the same technical setup in gold stocks as it is for gold. Let's take a look at that. Sorry. Just while I'm here also, let me show you. So this is the last 6 months for the 10-year Treasury yield. So you can see in June we got up to a peak of 3.36. We then fell back under 3 by the start of August, and we've gone from 2.57 to 4.22 just in that, really it's only 2.5 months. So it's been quite a meteoric rise, and that's what's really upset the equities market. So if we just go back and just check on a few other things. So this is the ASX 200, but I would expect this to kick up on Monday. Bitcoin, for anyone that's interested, is just doing nothing. It's just flatlining it. Finished the week in the low 19,000 area, but it's where it was in June. So at least you can say with Bitcoin it stopped falling, but that's about all you can say at this stage. This is the gold chart. You can see most of the positive work was done on Friday, and if we switch over to a weekly chart, you can see that we've broken that 1680 support. Hasn't really fallen away yet, but it's clearly in downtrend. Lower highs, lower lows. Just be very, very careful in the gold market. Other commodities, copper was down a bit, and also nickel was down a bit. I suspect that was mostly about currencies. But in terms of your long-term portfolio composition, I think it's pretty reasonable to assume that copper and nickel prices will be higher. That could happen soon. But I think it will almost certainly happen by 2024 because there seems to be a great deal of factual consensus about the supply-demand deficit, particularly for copper by 2025. I mean, BHP talks about that a lot. So, I think you need to, whilst copper and nickel stocks aren't exactly flavour of the month at the moment, I think you have to expect that in the future that will be the case. The only problem in Australia with copper stocks, copper majors, trying to get exposure to a pure copper stock is actually quite challenging. Crude oil was steady, about 85, so not much happening there. There's the spot copper chart. There's the copper inventory chart. So we're starting to, for that's rolled over now. So we're starting to get a little bit of a drawdown on inventory. There's the nickel price, not a lot changed there. And there's the nickel inventory just kicking up a little bit. But really that's probably not significant at this stage. So wrapping it up, I think it's a really good time just to sit on your hands and just do nothing. Allow the options impact to subside. They're always such contrived weeks, and I don't think last week was any different. So let that subside. Sometimes that has a flow-on effect into the next couple of days of the following week. Just let earnings season progress. I think next week is a big week. I think that'll really set the tone for the US market and therefore for the rest of the world. And as I've been saying, for many weeks and for many years to members, just get organised in detail. The more you can pre-think things, the more you can anticipate market ups and downs and what your response will be to those ups and downs, then the better off you're going to be. Portfolio analyst last week, we looked at small megatrend stocks that are on my watch list. These are stocks that have got an X factor in various battery materials markets. They're ones that, they're early stage, so there's higher risk, but they are ones that have got an X factor, and so therefore they've got a greater chance of success, and they certainly do provide some leverage to the theme. And I presented some more perspective on the risks around theme ETFs, which I think is very valuable because a lot of people get drawn into looking at thematic ETFs because lithium is so hot as a topic that you would think that if you buy into a lithium ETF that you just have to do well. Well, that's quite the contrary when you take a broader in-depth look at that particular space. That's it for this week. There's more information on my website. There's my email address, and I'll be back with you next Sunday. Cheers.